Let's move on to Social Security benefits. Social Security provides 4 main types of benefits: retirement, disability, survivorship, and a small death benefit. The death benefit is currently $255, which hasn't changed in decades. In the past, $255 might have been enough to cover burial expenses, but nowadays, a modest funeral can easily cost $10,000 or more. The $255 is really only enough to cover a nice floral arrangement if you shop around. Let's explore the federal income tax treatment for life insurance and annuities, including premiums, proceeds, dividends, and withdrawals. Instructor discusses the tax treatment of life insurance. First, let's look at life insurance. When it comes to premiums, the amounts Pearl pays for her life insurance are not tax-deductible. However, the death benefits, or proceeds, paid to her beneficiaries are generally income tax-free. The tax treatment of cash value withdrawals depends on the amount withdrawn relative to the premiums paid. Let's say Pearl has a policy with $12,000 in cash value, and she's paid a total of $8,000 in premiums so far. If she withdraws $5,000, that entire amount is considered a tax-free return of premium. After this withdrawal, she still has $3,000 of premium remaining in the cash value account. Instructor provides an example of a taxable withdrawal. Now, if Pearl takes a second withdrawal of $4,000, that will be a taxable event. Here's why. The first $3,000 of this second withdrawal is a return of her remaining premium, but the last $1,000 represents interest earned on the cash value. If Pearl had left the money in the policy, the interest would have grown tax-deferred. But by withdrawing more than she's paid in premiums, she's triggered a taxable event on the excess amount. Instructor discusses the tax treatment of dividends. Regarding dividends, remember the $62 dividend example we discussed earlier? Pearl has several options for using that dividend, such as taking the cash, applying it to future premiums, accelerating the policy's payoff, buying a 1-year term rider, or letting it accumulate interest. Regardless of how she uses the dividend, receiving it is not a taxable event, since it is considered a return of life insurance premiums paid that have already been taxed. Instructor moves on to the tax treatment of annuities. Now let's consider annuities. Suppose Pearl buys an annuity to provide Malik with $2,000 per month, starting at age 25, to help cover his living expenses. This is a regular annuity, not a retirement account. Because Pearl is funding the annuity with after-tax money, the premiums are not tax-deductible. Instructor explains the taxation of annuity payments. When Malik starts receiving the $2,000 monthly payments, part of each payment will be taxable, representing the interest earned on the annuity. The other part will be a tax-free return of principal. Malik's accountant will calculate an exclusion ratio to determine what percentage of each payment is taxable. For example, if the exclusion ratio is 40%, then $800 of each $2,000 payment would be tax-free, and the remaining $1,200 would be taxable. Instructor discusses the tax treatment of annuity cash value withdrawals. If Pearl withdraws money from the annuity's cash value, she'll owe taxes on any amount that exceeds her total premium payments. So if she's paid $8,000 in premiums and takes out $10,000, the first $8,000 is a tax-free return of premium, but the last $2,000 is taxable interest. Great job on completing this video. Now it's time to test your comprehension of the concepts we just discussed. This video corresponds to ICAP quiz course number 39. Remember that number? Click the link in the comments section to access the Insurance Class Assistance Program, also known as ICAP. Once you're there, look for quiz course number 39. This quiz will help us see if you truly understand the material and are prepared to move on to the next video. Don't forget, ICAP quiz course number 39. Good luck and keep up the great work.